When you start something, there's three things you can count on. It's going to take longer, cost more, and look different.
I think one of the best things in the low-hanging fruits from an opportunity standpoint to invest here is that there's a rich ecosystem.
For me to get this vision, what are the things that have to be true?
Going through a lot of middle market acquisitions, the length of time and the size that a company will grow to.
What are just some principles that come down to this is paramount?
I think it's forgotten when industries are seemingly baked, but there is a technology risk that we're just not considering, right?
They're not just going to buy once, that they're going to buy again,
Yep.
and that they get hooked into buying again.
Hey, welcome to the Acquirable Podcast, where we talk about making your company irresistible. We know that to make a company irresistible at exit, you have to have four things dialed in: your efficiencies, your financial, your culture, and your scale. And we get the chance to bring on industry leaders and disruptors to talk about how they experience their life in building irresistible projects. Kim, thanks so much for being with us today.
Thank you for having me. This is super exciting to be here.
Oh, we're thrilled to have you. So one of the things we always talk about when we start is everybody imagines this beautiful, wonderful euphoria of exit. And I'm going to exit my company and I'm going to live the yacht life and the travel the world life. And they see that picture, but what they don't see is the incredible challenge of getting there. So let's talk a little bit about, let us peer behind the curtain a little bit and talk to us about kind of the reality of building a company that's irresistible. Maybe even take us into some of your own journey and some of the challenges that you had to overcome to build something that was irresistible.
Oh my gosh, yes. It's definitely been a difference between the, what do they call it? There's the demo, and then there's the reality of owning the product.
Yes.
Definitely. So, as a serial entrepreneur, I have founded, funded, grown 7 companies. As the founder, chair, and CEO of Founders First Capital Partners, this is my 7th venture.
Wow.
Of my prior 6, 5 of my prior 6 were tech companies, had 3 successful exits out of those. But what I thought going into many of those businesses, what the end game was going to be and the journey getting there, again, it was the demo versus the reality of going through that. But, that's, so many business owners start businesses to solve a personal problem. That's why I look at what I've done with what I did with Founders, because with my very first company, my goal was to launch that company, grow it and be a small cap NASDAQ company. That didn't end up happening. It ended up being acquired. But, just the journey of what it takes to make all of that happen. And then, I had, went on and founded, 5 subsequent companies. A couple of those got acquired as well. And thinking through, your vision, what actually happens with those particular companies, understanding the whole scenario planning, pivoting, because that's another way of getting there as well.
Yeah.
But I would not have taken away that opportunity at all.
I always tell people when you start something, there's 3 things you can count on. It's going to take longer, cost more, and look different. And it's just going to, you have this vision and you're like, this is what it's going to look like. This is how long it's going to take. And this is what it's going to cost. And I'm like, I promise you, it's going to take longer, look different, and cost more. Tell me a little bit about maybe the difference between some of those ventures that got acquired and maybe one that didn't. I, like you, have started several companies, and I've had 3 acquisitions and 2 that didn't. Talk to me a little bit about maybe what were some of the emotions or nuances. Was it just opportunity? Was it maybe some of the ways you led them? What was something that got one acquired and that you learned and this one didn't, and here's why?
Well, so just thinking from, some of the assumptions that you go through and say, yeah, this is the mission vision of what we're going to do. But then, now as somebody who's a 30-year entrepreneur, there's some technical things that you can go through that you have to look at. Like, for example, there's market risk, there's model risk, there's, those particular components. And for my very first venture, it was launched in the .com era. Technology risk. You're going to go through and have to be able to say, for me to get this vision, what are the things that have to be true, or that I'm assuming are true?
Sure.
And with my very first company, the assumption was based on research that there was 20% adoption of high broadband technology in homes. And, you had Jupiter and all these people that said, yep, this is the adoption. But the reality, that wasn't it. It was really less than 5%.
Wow.
And so as a result, that has an impact with regards to your overall model. Now, what you do, that you learn through this, you pivot along the way, but being able to do that early and really being able to do that level of what has to be true to make this happen, and doing the scenario planning, best case, mid case, worst case, and doing that regularly.
Yeah.
For us, we did pivot, because we were a Netflix, to deploy continuing education to largely physicians, different type of specialty physicians, instead of them going to a conference.
Yeah.
Because only 30% of these guys would go to a conference, 70% didn't. First of all, you need to ask your physician, how do you get continuing ed? And how many, and they call it a practice for a reason. And so the assumption is for these 70%, how are you getting continuing ed? And if you're doing it from a tape or a book, you need to be concerned about that. But, the technology risk was that people had broadband adoption, and so ours was a video-based platform to be able to do that. And we pivoted eventually to do it by audio and basically video is very fat data. But, by the time we pivoted, there were some other external constraints that had that impact. But, from a customer adoption, we were partnered with 100 different medical societies, in not just in the U.S., but nationally. So having that infrastructure, having those level of interest from people, because the other thing is you have to look at, does your customer, are they a innovator, early adopter, laggard, is there a trust gap? All of those things matter. I mean, and I would even go through and say the biggest thing when you think about any venture is, what's the distribution? What is the way that connects you to your customer, and the likelihood that they're not just going to buy once, that they're going to buy again, and that they get hooked into buying again. And those are the things that now, as a 7-time entrepreneur, I can spot some of those things quickly. But, first time, there's so many new things that you're dealing with. But all of those times where people say, oh, I've got this whiz-bang technology, just know that's not enough.
Yeah. I love it. We always talk about pre-mortems, and, a lot of us do post-mortems, what went wrong, but that pre-mortem of what could go wrong, what do we need to know? And you just rattled off so many
lot
good
of
things.
pre-mortems.
And you're like, man, if you would have asked those questions, not you, but individuals when they get early stage, it's so helpful to actually understand your data, actually understand. And a huge one is your customer. I mean, are these folks early adopters, lagging adopters? That's been a huge thing that I've learned.
And I think it's so interesting. You two are both tech entrepreneurs, right? By kind of background and base. And I always find it so interesting because I'm kind of an old industrial guy, right? And the technology risk that you talk about, and you've talked to me about it in some of your companies before too, is I think so important. And I think it's forgotten when industries are seemingly baked. But there is a technology risk that we're just not considering, right? And there's infrastructure that you're assuming will be in place, or that will grow, or that will continue forward. And so I think that's a really interesting one, especially for the folks that listen to this and are in more industrial types of companies, just to think through what the technology risks are.
Also understanding your customer, right? I mean, if you've got some new whiz bang concept, and even if it's right, even if it's good, even if it's thoughtful, it doesn't mean that your customer is
going to value it
to adopt something like that. So in this podcast, we talk a lot about making a company irresistible. So primarily our audience is going to be later stage. Man, how do I prepare to exit well? And so we talk about these 4 things: efficiencies, financials, culture, and scale. So maybe introduce a little bit to us those first processes.
Yeah, I would love for you just to talk through each of those and maybe give us some examples or some wisdom that you have around each of those, starting with efficiencies and just what makes a company irresistible from an efficiencies standpoint.
It's super important. And the reality is, what got you here won't get you there. And, you have to make those investments in those policy, procedures, processes, roles and responsibilities. Every business needs to go through that. And many times they don't. And it's sometimes you have to have somebody externally that says, you know, if you got hit by a bus, how are you going to operate? Who's going to do these particular things? Especially because many non-tech companies may not have a board that holds them accountable and says, you know, are you ready for this? They may not have outside investors that ask the same things, but it's super critical because that's what makes you acquirable.
That's right.
To use you guys as, you know, the name of this podcast. You have to be able to make certain that you can continue to operate without you. And so, you know, the people that are willing to make those investments in the business to make certain that they have these practices in place, it's super important, and have metrics, benchmarks. Like one of the things, what we do with Founders, my current company, we do have on the nonprofit partner that I also founded, you know, having people go through, this is what it takes to grow, learning to grow, putting a framework like, you know, we personally use either EOS or traction and the KPIs that you have in place, and really looking at, you know, how are you doing, and being able to not just you, the founder owner, but that you have a team that does that. And those are some of the things that you have to make the investments to do to make all those things happen, so that not just that you're operating efficiently, and that you're assessing changes that are happening in your industry with your customers, and then externally how you're adjusting for that.
It's amazing. I think if you, as a founder leader, if you made a list of here's all the things that can't happen without me. We were just with a client the other day, and we were talking about all their SOPs, and so where do I find those, or is it video based? How is it? And they're like, well, it's all word of mouth because we don't want our competitors to know kind of our secret sauce. And I said, I understand that, but word of mouth in terms of a transferable motion is very difficult when we go for a sale, and somebody says, hey, I want to, you know, stress this business with cash or opportunity, and we don't know how to transfer information other than through word of mouth. We got to figure that part out. That is not an efficient way to scale a business. There's got to be infrastructure for
We
that.
talk a lot about, you mentioned it there, but we talk a lot about the stressors that get placed on a business, and they tend to come from capital or fast growth or acquisition, either being acquired or doing add-on acquisitions. Those all place stress on a business. And so if you have word of mouth procedures and processes, how do you roll that out to, like if it's a geographic based business, for example, how do you roll that out to 10 new cities in a year instead of 1 in the next 2 years?
Yeah, it's having that feedback of, you know, congratulations, you got to this point. Now what? How are you going to leverage all this work of where you've gotten to this success such that it creates a wealth opportunity for you, for your team, for your community, and, you know, just having all this stuff in your head. Not the best answer.
Right. Yep.
Yeah. Talk to us about financials. And I'm really curious because now in your 7th venture, you're a capital provider. You are, I think, likely the person in the situation that's imposing financial reporting discipline at this point, I would guess. So talk to us about financial reporting and just the importance of that.
So that, you know, it's interesting. Often one of the top 3 weaknesses for most companies is their financial health. And it's one of those things that as you grow, as you're successful, you have to evolve that. And that may mean you need to make changes to people that are doing this particular thing. And there's an assumption that, well, if you've gotten to this particular component or this level, then you must have it all worked out. But so often you'll see companies that don't have that in place, and they don't have the level of rigor in place, and that can have an impact on the value of the company. It is a common hurdle for businesses getting access to capital, getting access to resource, looking at, you know, well, I don't understand. It's like, not that you're going to have to do these things, but you should have somebody that is, you know, like many times they'll invest in sales and marketing, but they won't invest in their financial health. And that is just as important.
Yeah.
It's critical, but there's a big trust gap, because many people will go through and say, well, you know, I haven't found anybody really good, or I really haven't found anybody that I trust associated with it. And so they stay in a sense of, mediocrity, because this is a fear, anxiety, a hurdle that they haven't overcome, but it's critical.
What are ways that you invest? Someone's listening going, I heard you say this sentence, you need to invest in your financial health. What are some practical ways that somebody can invest in their financial health in their company?
So first and foremost, with many of the hats I wear, I'm also I love saying this, I'm a columnist for Inc. magazine.
Oh,
and
fun.
monthly,
Oh,
I
that's
write
awesome.
an article about, how small businesses can overcome issues. And my current article is about how to level up your financial health so that you
that's
can
awesome.
grow to be that gazelle, $10 to $100 million
Yeah.
business. The baseline is some of the things we just talked about. It's the quality of people that are doing your financial. It's the frequency and the level of granularity, the reporting, and that you have the baseline budget projections and you measure against performance and KPIs. Table stakes. You've
Yeah.
got to go through and do that. The next is you've got to go through and do other scenario planning, cash forecast, margin analysis, and not just do it internally. Find out the best companies, what are theirs, and what can we do beats that, and not just go through and look at it from a revenue standpoint.
Right.
Because most people think, oh, it's just top line revenue.
Exactly.
But you've got to look at, for this other company or these other companies, what is the profile of people that's driving the financials? What are they doing, their practices? And it doesn't have to just be companies that are actively going. You can also look at people that have retired, sold. Ask them. People always want to tell you, if I could do this again, these are the things that I would do to improve, and take advantage of that. When I have new opportunities presented to me at Founders First, I'll ask my colleagues, how do you do this? How did you assess this? What is not just what did you do? Who are the people that you have on your team helping you do that? What is their qualifications? And the financial one is always the one that's missing from that.
We see it's surprising, right? Going through a lot of middle market acquisitions, the length of time and the size that a company will grow to, where the financial reporting is subpar. And it's interesting because it's viewed as a cost center. It can become a profit center if you know how to manage it and leverage it correctly. But once you get to a sale, you may have a very valuable enterprise. The financial reporting and the things you just talked through are how you prove that out. And so if you don't have that, then it's very difficult to prove you have something valuable, even if you do. I think one of the best things in the low-hanging fruits from an opportunity standpoint to invest here is that there's a rich ecosystem of CFOs, longtime CFOs of larger companies, of really well-run companies who you can engage on a fractional basis to design and kind of run these processes and build teams around it.
Very, very much so. I mean, we just kicked off a series, this capital activation series, and this year we did it in 4 regions, and having a select group of 15 companies meet with key solution providers, and one of them, at least one, or if not two, are reputable fractional CFO
That's great.
organizations, because this is one of the biggest barriers that prevents them either from getting a contract, getting access to capital, and then you look at, being able to position yourself so you can do an acquisition. And there's so many businesses, especially, we focus on some of the under-resourced communities, that's such a fear. And it's like, you know what? Is it really worth it to you to not have the best opportunity for being able to build these net new relationships?
I think that's one of the things that matters so much is you said it earlier, like if you don't know something, you tend to just ignore it. And that's not a solution.
No, it's
And then the second thing is, if I don't know how to do it, I'll just focus on what I do know, which is top line revenue.
Yeah.
And so the solution for financial health is simply growth, not management. And I think that people, if they begin to understand, like, healthy financials look like, and it's more than this, but 2 motions: 1, growth, and 2, managing the growth. And it's like, I don't know how to manage the growth, so I'm just going to keep focusing on growth. And I think getting the right people in your organization that say, this is what it looks like to manage capital, this is what it looks like to manage resources, these are the benchmarks, KPIs, and somebody's going to listen and go, I don't want to deal with all that. And it's like, you don't have to. But you need to find somebody to do it. Yeah.
I look at it as it's one of the other components of culture. And also, as a leader, you have to recognize you are going to grow. In order for your organization to grow, you have to grow. And that means you're going to have to be comfortable with being uncomfortable, recognize you are going to have these anxieties, but it's not forever. And, is it really that you're going to put your business at that substantial risk if you do not solve this problem?
Right.
And that's really what it is. You cannot grow your way out of a poorly operated or poorly financial reporting business. You just can't, So you have to, be able to recognize, as a business owner, you do have highs and lows. And being able to address that vulnerability. Now, you don't have to go through this by yourself. There is lots of programs that you can, have peer groups, to help you and help you understand, because so many people go through these challenges as well. You're not alone.
Yeah.
But you have to be able to embrace this and do this.
So you mentioned that even healthy financials are part of culture and the culture of learning and growing. And we know that in order to make a company irresistible, culture has to be thriving. Talk to us a little bit about what you've learned through the years of creating a healthy culture for a company. Maybe some things you learned the hard way, maybe some things you've seen that you've now repeated in other businesses, but talk to us a little bit about just cultural health in an organization that would make it irresistible.
You look at so many companies, capital's one piece of it, but you have to have people that want to do what you're seeking to do. You have the alignment, they have the capacity to do it, and they get it. And there is that synchronization and collaboration that are so critical. And you see, and to have a successful, growing, thriving business, that you have that. And that they have prioritized where the business is going, and they see that this is not just a disjointed thing. I'm doing this for the business. I'm doing this for me, because if I do this for me, I do this for me to help the business along. And it's being able to, as a leader, hire, develop, and retain people associated with that, and recognizing many times that you might not, if you're successful at it, some of those people may stay, and some of those people may, move on and launch their own business. I was fortunate enough, one of my founding investors is one of the co-founders of Costco. And he talked to me about so much of all the employee development culture that most of the people, when they go into a new market and launch, 90% of the people are people that are at the ground level, that they're coming out of the colleges and they have a training program to develop those people and have them grow with the organization. So, 10% come from some of the other organizations, and then the other 90%. And if you can find and apply some of the resources to have that development pathways for folks, it can be such a great thing for the business.
I love that thought of synergies between this is good for me and this is good for the business. And I think sometimes those can be imbalanced where, it's all about me, or it's all about the business. And I think when they're not synced up, then all of a sudden you find employees coming in saying, how is this benefiting me? And you see the business going, how is this benefiting me? And it's got to be, how is this benefiting us mutually in order to create a shared vision and future?
That truly is it. It's like, how can I be able to develop my best self as I'm contributing to where the business is seeking to go?
I love that. So speaking about where the business is seeking to go, obviously scale matters. And when you look for a business, somebody's looking to buy a business, not to keep it where it is, but to take it to where it's going. And so often when we talk to founders and leaders that are looking to be acquired, they're so rightfully so excited and proud about what they've built, and they want to show, like, look what I've done, which is beautiful. But the buyer's going, congratulations, that's not why I'm buying it. I'm buying it for where it's going. And when we think about scaling a business beyond what maybe the founder or leader has done, what are just some principles that come down to this is paramount if you're going to scale a business beyond where you are now? What you said earlier, what got you here won't get you there. Somebody's trying to get there. What are just some fundamentals when you think about scaling a business?
Starting with a big enough vision, and that where somebody may take the business the next thing. Again, it's like recognizing you built it to this point. this will be the next level of life.
Mm-hmm.
You know, unfortunately, so many founders think of their business as their child.
Mm-hmm.
And so it's like, I have this vision for my child, as opposed to this is a foundational entity
Yeah.
that can add and solve problems, and there's benefits from it as
Mm-hmm.
well. And so, you know, marrying between the scale component and also the people component, many business owners will implement things such as stock ownership plan that are tied to KPIs and having those pieces, because when you're selling, people are looking to not just, you know, those cash flows and all this other, is because you have a high performing team
Right,
to go
right,
along with it.
right.
And are they properly incented to continue to grow
Right.
the business? Not just, oh, I was just
interesting.
doing this
Yeah.
for the founder. No, I'm doing this because, again, it's helping me where the business is going to grow, and that will be the next, it may be the next owner.
Yeah.
And many times people don't think
Yeah,
about
it's an
that.
interesting thought.
The other side of it is what's evolving in the overall market. You know, when you want to scale the business, it may be, I'm going to address these 1-2 issues in the market, but there's more issues than that. So it requires a continuous improvement loop that you're constantly seeing. What is the continuous thing that we need to do?
Right.
You think of companies like Netflix. I use that as an example because my first company, Netflix, didn't exist when I started. But when I tell people what we did,
It's made it easy for you
It
to
made it
explain
easy.
what you do now. Yeah.
exactly. But you look at how they evolved. You know, they started with rental of a rental subscription program, and then eventually evolved to streaming. And then they had to evolve to actually creating their own content
Right.
and all of those particular things. And they had to evolve from the founder who started it to eventually exiting out. The similar thing
Yep.
with, as I shared with you, you know, one of our founding investors from Costco, how they have evolved. And you have to look at it as the focus has to be on, we're serving our customer and where their needs are, and being able to look at and have that loop of assessing with data
Mm-hmm.
what are additional needs that need to be served, and how, as we evolve, can we do this such that we own our destiny.
Mm-hmm.
And when you look at both those two organizations, I mean, especially Costco, they're 45 years old.
Yeah. Wow.
Yeah.
And they have evolved and scaled to such that they're, you know, one of the most desirable publicly held companies.
Yeah. You know, you think about scale and you're always thinking about sales motions and sales moats, but I love that concept of, you have to think about scale too. Are your employees, is there an infrastructure and a motion for them to be incentivized to grow the company? Because it really does add a whole new dynamic to it, where it's like, oh man, we're going to penetrate this new market. We're going to create this new product. We're going to, you know, capture this new piece of data. That's how we're going to keep scale and moats, et cetera. But what about the people? Like, are they properly incentivized to take this to the next level? And that's one of our proofs of scale, is that our people are incentivized. I love that.
And the other element with some of the companies I held, we were a certified Salesforce solution provider. And my first company that I got that certification is when Salesforce implemented the whole Salesforce, you know, app exchange. And they talked about how they wanted to grow. 6 to 70% of their growth was going to be by selling additional revenue streams to existing customers. That's the other issue with regards to scale. You do not have to go through and scale by saying, I'm going to always have to acquire net new customers, but you have to have your business not just a vitamin or a vaccine, but ideally you want to be the cure for cancer by providing such an ultimate experience and solution for your customer that they look at, well, I had enough trust in them because they solved this and this one, but because of my trust, they're going to solve these other things.
Yep.
And that's the fastest, more
That's right.
efficient way of scaling, is if you have that relationship with them, that you're adding these other streams.
Well, we talked about that with banking, you know, where it's
Yeah.
like, hey, we'll help sell your business, but there's all this need.
In the same customer base. Yeah. To be with somebody for the 2 to 3 years before they sell.
Right, because they don't have that expertise. And when you think about it, this is, you know, well, you and I have gone through these mini exits, but most people, they may be one time. And
Right.
so, you know, it's like you can try to do this by yourself or wait till But if you really want to maximize, there's all these things that you need to do. And sometimes getting people to change their behavior to do the things that they should be doing, it's sometimes learning, well, these other companies did these particular things. If you really want to take the risk and you're confident that you are going to figure this out on your own, this just do it with your eyes wide open and know this is the risk that you face by not investing now to do it.
Yeah. I love some of what we're talking about here. I'm a big reader, and some of my favorite books in business are The Breakthrough Company and Good to Great, which are similar, but Good to Great is focused on really large companies. Breakthrough Company is focused on middle market companies, but each of them, through objective research, kind of arrive at a similar conclusion that it takes a leader to step back and objectively they call it crowning the company in the Breakthrough Company. And then in Good to Great, they call it a level 5 leader. So someone who thinks about the company as separate from them, their identity is not enmeshed in the company, but it allows them and it opens up the freedom internally for the leader to think about employees and prioritize employees, think about the customers and what else they can do, because it's not them anymore that is running this company or growing the company or carrying it on their back.
It is when you get to different various stages that you have to go through those. And depending on the maturity of the market that you serve, being able to recognize that it's not just the founder brand, company. It is having this continued life of the business associated with it.
So one of the obviously folks that are listening to this are going, I want to be acquired. I want that moment. And Josh, that's the side of the fence that you sit on in our organization. Talk to us about, an exit that you had and getting in that transaction moment and something that you guys, love to hear you guys riff on that.
And we could pick any one that you want or any combination that you want, but we'd love to just talk through kind of a case study of an exit that you've been through and how it came to be. Were you looking towards an exit? Did somebody approach you and that's what compelled you to think about it? Just talk us through that.
So if it's okay, I'm going to use two.
Okay.
Yeah.
So one is because most of my business have been institutionally financed. That was the kickoff. You had to start with the exit in mind.
Right.
And my partner were like, this is the point that we're going to get to with regards to these exits. And then looking at the time frame, because when you have a company that's done with other people's money, it's not your horizon. It's generally the horizon.
Their horizon.
Yeah, exactly.
So from a context associated with it. But then I look at some of the portfolio companies that we work with at Founders First. Most of those companies were bootstrapped companies. And the whole idea, and so going back to, with my company, I had institutional investors. So it was like, you have to agree. It's like a marriage. We are going to exit this thing.
Yeah.
And we have this time horizon that we got to do it.
I call it the golden rule. He who shares the gold sets the rules.
And you have a board that you constantly have this accountability of this is what you're going to do. Most businesses are not set up that way. It is, hey, I started this business, I found this problem, and so going back to the, be it financial health, culture, people, having a board is super important. Minimally an advisory board. Best case, you have a governance board to hold that business owner accountable for the things that they're signing up to doing, and they're not just going through and saying, it's my lifestyle related thing,
Right?
Because that's the whole, the outcome. So being able to go through, have these commitments. If you're going to go through and say, in 3 years, I want to be ready to exit. Who's going to hold you accountable to go through and do those particular things, and being able to set the regular cadence of what's happening, surveying what's going in the market, where do I stand, what are the changes I need to make? Because on the other side, when you're institutional finance, you have to constantly look at, you do the 409A valuations and all this other stuff, and you have those particular structures in place. Most, non-institutionally financed company, even those that use bank financing, there's nobody who's holding them accountable that says, do you know where you stand compared to others? If you got hit by a bus today and your family decided to sell this business, how are they going to be set up, for doing those things? So this is why, doing this assessment, seeing what the value is, seeing what those components are. Who are the possible people who could acquire the business? Because on the institutional side, you hire a banker or an advisor to go through and said, these are the potential pipe of companies, and I'm going to make the connection and all this other stuff. You have to go through and put those types of rigor in place in order to be ready to sell. And so we had a company from our portfolio that actually got acquired by Deloitte. They came to us. The founder did not have the perception of, I'm going to sell one day. At most businesses, they're started and funded with credit cards, factoring, or extractive merchant cash advance funding. For her to get to the next level contract, she went to somebody and they referred her to us. She refinanced her company, and then we provide, kind of junior mezzanine financing. She was able to grow to a certain point, advance to SBA funding, but also her key partner was Deloitte. And many of those firms, be it Deloitte, Anderson, EY, they will increase their capacity by acquiring companies like that. And so being able to tell them that's possible is key. That, in some period of time, it's 3, 5, 10 years, where do you want to take this business? And having that introduced conversation with them. That's the other side of it with these small to, lower middle market companies. Having a solution provider that challenges them with that question and saying, where do you want to take your business in 3 years? And also, how are you going to unlock the wealth, the potential of this business?
Did you, let's use the first, remind me of the name of the Netflix for physicians.
Seminar Source.
Seminar Source. Okay. In the case of Seminar Source, when you were acquired, had you had that strategic acquirer in mind? Were you building to that acquirer?
So that we had a relationship with them.
Okay.
So, they actually were an investor, so we had a relationship with them.
Okay.
Was it going in the door saying that was going to be the outcome? No. But I will tell you what I have since learned that, with many of my colleagues, that's something that they even go through and have it much more crystal. I mean, this was in the, early 2000s, but, if you can look at, those potential possibilities and understand what are the types of organizations that they acquire and what is the journey that they have to go through is key.
Well, listen, we're, we're so excited to be able to share time and look through these fundamentals. And I think for me, my big takeaway today is drill down. I think a lot of times we talk to founders and it's almost drill up, look where you're going. But I think if you look at each of these fundamentals and Kim, what I'm so fascinated by with the way that you described your journey is everything was drilling down. Everything was data. Everything was one step further.
There's an analytical rigor to how you approach this all.
Yeah. And so if you're watching this today and you're going, where do I go from here? I want to just encourage you to drill down at everything that you look at and really be data-driven, analytical-driven, and realize that most likely that's not something that inspires you and gets you excited because you're a visionary founder and you can see the next motion or opportunity for your customer. But if you want to be truly irresistible, if you want your company to be acquired, drill down, because in the data, in the story is health and future and building a company that is truly irresistible. Thanks so much for joining us today. Kim, thank you so much for being here. Goodness gracious, what a great time.
Fantastic.
We're so glad that you're here.
Thank you.
Thank you.